Let's welcome in Rupal Agarwal, Senior Research Analyst, Asia Quantitative Strategy at Bernstein. She's joining us right now to take some questions. Rupal, good morning. Good to have you with us here. Thank you for your time. What's the quant picture telling you about where markets are headed, global markets broadly, Rupal? What's the perspective?
Sure. So I think from our perspective, when we started of the year, at least on Asia, we were quite bullish, and we still maintain a bullish view on Asia over the 12-month period. But in the short term, we do think that risk of a global recession has increased since the beginning of the year, and hence, we are still taking more of a balanced approach across the region, including, even for a market like China, where we do think that we are very close to a market bottom. So I think China probably is one area where we are very closely watching, that we are heading more towards a bottom. But most of the other Asian markets, at least, we are still taking a much more balanced approach.
Okay, so you're saying that the risks of a global recession have increased since the beginning of the year, but in terms of individual, markets, there's a bottom formation perhaps in China. Any other emerging markets that look like, there could be at the bottom and there is a longer structural upcycle, perhaps for the next 12 to 18 months?
I think a lot of that bottom formation, in our view, happened back in October, and that is the reason we saw this significant risk-on rally across Asian markets, in the month of November, December, and January. A lot of that has moderated, I would say. And so most of the Asian markets are well positioned from a 12-month perspective, but in the shorter term, we do see some risk building because of, as I said, the global recession and the fact that a lot of Asian markets are moving much more closely to the US equities than it typically tends to be, except for, of course, China. So I would say China stands out as one of the key markets in focus for us. Rest of all the other Asian markets positively positioned for the next 12 months. We are slightly worried in the short term.
All right. Morning, Rupal. Always good to hear your thoughts and good to see you in. Rupal, so it's China outweighing India at this perspective, right? Primarily because of valuation concern. Would that be the case? And also I wanted to ask you, since most of the commentary that we get is factoring in a rate cut towards the end of this year from the Fed. Are you in that camp?
Okay, so firstly, on China versus India, I would say when we started of the year, we were much more positive on China, much bearish on India. Our bearish view on India has slightly come down because of valuations coming back to 10-year average levels. And, the disconnect that we were seeing between market valuations and the 10-year bond yields in India, that has completely normalized. Having said that, I think the way that investors have been positioning across China and India is very different. And that actually sets up a very interesting, market environment. So for China, what we are seeing is that there's been a lot more hiding in safe haven assets and defensive, trades in the market. Because of that, something like, say, a low beta trade is actually trading at, it's the most crowded that we've seen that trade in the last 10 years. Versus if we look at on the India side, it's completely the opposite. High beta has been doing very well since COVID bottom, and it continues to trade at all-time highs. And in fact, it is, the most crowded. So it's a complete opposite setup that we are seeing from a pure quant perspective. One would ideally want, high beta to start looking much more attractive for us to become more convinced that we are heading towards a more sustainable risk-on rally. That is something that we are now seeing in China, but not necessarily in India. So it's not completely a valuation-driven call. It's also driven by, how investors have been positioning and this significant trade that we've seen in the last 2 to 3 years build up in each of the markets.
Just one follow-up there. So, from a quant perspective, how are you looking at rate sensitives now? Because in a market like India, on the hope perhaps that there will be a rate cutting cycle anytime soon, a lot of the rate sensitives, banks, autos, real estate has started to pick up. How are you looking at these pockets?
So yes, so we have been positioning in some of the rate sensitive areas. We still like some of them, but the way that we always look at it is approaching it more from the angle of being still more defensively aligned. So yes, we will still be comfortable owning, say, some big financials, but only the ones which are giving you very low volatility. Similarly, on the auto side, we will be comfortable owning the ones which are giving you high yield, which is essentially a defensive value trade. So that's how, we are still approaching the market, because if you look at Interesting in India since the beginning of the year, I would say it's become actually an even better stock pickers market. The dispersion across the market is very high. The correlation within the stocks is very low, which is great time for active stock picking. And in that context, what we say is that the key support that we are getting across the market is essentially from defensive pockets, which is essentially either you look at high quality names, or you look at high yielding names, or you look at companies that are giving you low beta. They are actually trading at almost all time high discount to the market, almost one standard deviation below the levels that we've historically seen. So valuation wise, very comfortable. Even from an earnings standpoint, we are seeing these names being net upgraded relative to the market. So I think that's the kind of stocks or sectors that we are more focused on. So I would say from a sector standpoint, it would translate into reasonable exposure towards staples, healthcare, technology, and only select banks, the bigger ones in financials. It's largely a negative discretionary industrials trade.
Okay, all right. Rupal, we'll leave it there. It's always a good conversation. Thank you very much for joining us with that perspective. Rupal Agarwal, a senior research analyst, Asia Quantitative Strategy at Bernstein.